Yo, nobody taught us money in school, so let me fix that for you.
Finance is essential to the management of a business or organization. Without good financial protocol, safeguards, and tools, running a successful business is more difficult. In 1978, Bacon Signs was a family-owned regional Midwestern sign company engaged in the manufacture, sale, installation, and maintenance of commercial signage. The company was about to transition from the second to third generation of family ownership. Bacon Signs, established in 1901, had weathered the Great Depression, World War II, the Vietnam War, and the oil embargo, and was working its way through historically high rates of inflation and interest rates. The family business had successfully struggled through the ebb and flow of the regional and national economy by providing quality products and service to its regional clients. In the early 1980s, the company's fortunes changed permanently for the better. The owner recognized that the custom signs built by his firm were superior in quality to the signs it installed for national franchises. The owner worked with the company's banker and vice president of finance and operations to develop a production, sales, and financing plan that could be offered to the larger national sign companies. The larger companies agreed to subcontract manufacturing of mid-size orders to Bacon Signs. The firm then made a commitment to build and deliver these signs on time and under budget. As Bacon Signs' reputation for quality grew, so did demand for its products. The original financing plan anticipated this potential growth and was designed to meet anticipated capital requirements so that the firm could expand how and when it needed to. Bacon Signs' ability to manufacture and deliver a high-quality product at a good price was the true value of the firm. However, without the planning and ability to raise capital facilitated by the financing plan, the firm would not have been able to act on its strengths at the critical moment. Financing was the key to expansion and financial stability for the firm. Introduction to Finance. Why it matters. Why it matters. Introduction to Finance. In this book, we demonstrate that business finance is about developing and understanding the tools that help people make consistently good and repeatable decisions. 1.1. What is finance? Learning outcomes. By the end of this section, you will be able to describe the main areas in finance, explain the importance of studying finance, discuss the concepts of risk and return. Definition of finance. Finance is the study of the management, movement, and raising of money. The word finance can be used as a verb, such as when the First National Bank agrees to finance your home mortgage loan, or it can be used as a noun referring to an entire industry. At its essence, the study of finance is about understanding the uses and sources of cash, as well as the concept of risk-reward trade-off. Finance is also a tool that can help us be better decision makers. Basic areas in finance. Finance is divided into three primary areas in the domestic market: business finance, investments, and financial markets and institutions, as you can see in Figure 1.2. We look at each of these here in turn. The three basic areas of study in finance. Business finance. Business finance looks at how managers can apply financial principles to maximize the value of a firm in a risky environment. Businesses have many stakeholders. In the case of corporations, the shareholders own the company, and they hire managers to run the company with the intent to maximize shareholder wealth. Consequently, all management decisions should run through the filter of these questions. How does this decision impact the wealth of the shareholders? And is this the best decision to be made for shareholders? In business finance, managers focus on three broad areas. Working capital management, or WCM, is the study and management of short-term assets and liabilities. The Chief Financial Officer, or CFO, and the finance team are responsible for establishing company policy for how to manage working capital management. The finance department determines credit policy, establishes minimum criteria for the extension of credit to clients, terms of lending, when to extend and when to take advantage of short-term creditor financing. The accounting department basically implements the finance department's policies. In many firms, the accounting and finance functions operate in the same department. In others, they are separate. The second major component of business finance is capital budgeting. Capital budgeting is the process of determining which long-term or fixed assets to acquire in an effort to maximize shareholder value. Capital budgeting decisions add the greatest value to a firm. As such, capital budgeting is thought to be one of the most important financial functions within a firm. The capital budgeting process consists of estimating the value of potential investments by forecasting the size, timing, and risk of cash flows associated with the investments. The finance department develops and compiles cash flow estimates with input from the marketing, operations, accounting, human resources, and economics departments to develop a portfolio of investment projects that collectively maximize the value of the firm. The third major component of business finance is capital structure. Capital structure is the process by which managers focus more specifically on long-term debt and increasing shareholder wealth. Capital structure questions require financial managers to work with economists, lenders, underwriters, investment bankers, and other sources of external financial information and financial capital. When Bacon Signs developed its financial plan, the executives included each of these three aspects of business finance into the plan. How corporate finance decision-making activities relate to the balance sheet demonstrates how the three essential decision-making activities of the financial manager are related to a balance sheet. Working capital management focuses on short-term assets and liabilities, capital budgeting is focused on long-term assets, and capital structure is concerned with the mix of long-term debt and equity financing.